Welcome back to Learn-to-Earn. If you're new here, make sure to hit that subscribe button because today, we're diving into an important topic that every investor should consider: how to spot great investment opportunities without falling into the trap of bargain hunting. Investing in growth is cheap, really cheap. I'm sure many of you have heard the saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But what does this really mean, especially when it comes to stock market investing? Well, let's break it down. When most people think of a good investment, they immediately think of bargains. The buy low, sell high mindset. In fact, it seems logical, right? You find a stock that's been discounted, maybe it's underpriced, and you think, now's my chance to strike a deal. But here's the thing. This traditional thinking doesn't always apply in the stock market, especially when you're talking about growth stocks. You see, what looks cheap can often be expensive in the long run, and what seems like an overvalued stock could actually turn into the next big winner. You've probably heard about the PE ratio. The price-to-earnings ratio is one of the most common metrics used to gauge whether a stock is cheap or expensive. But here's the catch. The PE ratio reflects a company's past performance. It doesn't tell you anything about its future potential, which is where the real value lies. Think about it this way. The stock market isn't just about looking backward at past earnings. It's about what a company will do in the future. A company with strong growth potential might trade at a higher PE ratio, because investors are willing to pay more for that future success. And here's the catch. When you only look at the PE ratio, you're ignoring this crucial future component. Buying a stock just because it's cheap can be a trap. It's like holding on to a losing hand in poker. The stock keeps going lower, and the cheaper it gets, the more tempting it becomes to hold on to it thinking, hey, it's a bargain now. But here's the problem. The lower the price goes, the harder it is to let go, and the more likely you are to get stuck with a poor investment. Most investors fall into this trap because they think a stock is undervalued simply because it's cheap. But in reality, many of the best growth stocks never trade at a low PE ratio. In fact, some of the biggest winners in history had PE ratios over 30, even 40, before they skyrocketed. It makes sense, doesn't it? Faster-growing companies are naturally going to sell at higher multiples. So if you shy away from a stock just because the PE ratio or the share price seems too high, you might be missing out on the biggest market movers. Here's the truth. You don't find the most exciting, high-potential companies at bargain prices. The truly great companies, the ones with massive future growth potential, rarely show up in the clearance section. If you're looking for the next big winner, you won't find it in the cheap pile. You have to be willing to pay for quality. Take a look at some of the biggest success stories in the market. Companies like Amazon, Tesla, and Apple were all considered expensive at one point. They had high PE ratios, but that didn't stop them from becoming some of the most valuable companies in the world. So, what's the takeaway? Next time you're looking to invest, don't be afraid to pay a fair price for a truly wonderful company. Don't fall into the trap of thinking that cheap is always better. The best investments often come with a price, and that's a price worth paying for the future growth and success they can bring. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more insights on smart investing. Drop a comment below and let me know. Do you look for value or do you prioritize growth potential when you invest? I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next video. Happy investing.